Hello traders, this is Fawad Razak, Southern Market Analyst for City Index. Today is the 3rd of January 2024. I wish you a happy new year. So the markets have started quite weak in 2024, and this is in response to investors kind of pricing out expectations of aggressive rate cuts. Now, if you recall from the end of last year, equity markets rallied aggressively because of expectations that the Fed is going to cut interest rates aggressively, but some of those moves have now unwound. Still, the market is expecting interest rates to be cut in the March meeting. They are 75% confident of a rate cut. The probability of the Fed holding interest rates is 25% currently, meaning that 75% is now priced in for a rate cut, which is slightly lower than the end of last year when expectations were for around 80% or a bit higher for a rate cut in the March meeting. So incoming data is going to impact these expectations, and we'll have plenty of that this week, including the non-farm payrolls report on Friday. Depending on the outcome of these important economic events from the US, expectations for interest rates are going to be impacted again. And this will in turn have implications for all sorts of risk assets. So at the moment, you can see that bond yields have started to bounce back because of reduced expectations for aggressive rate cuts. But this could change, as I mentioned, depending on the outcome of data. So if we see weaker data from the US, then that will boost expectations of more aggressive rate cuts, which in turn should help to support things like gold, equity indices, euro dollar, and so on. Let's have a look at some of these charts now. As you may recall from my previous videos on gold, the precious metal is still trending higher on the longer term time frames. However, in the short term, we are seeing some weakness creep back into gold. This is because of the fact that the bond yields have risen, which is increasing the opportunity cost for holding gold. Nevertheless, the underlying trend is bullish. So the key levels to watch, 2033-ish, this blue line here, was a short-term support and resistance level in the past, where we also have the 21-day exponential moving average coming into play. This level is important in the short-term outlook. If it holds, then we could see another push towards that key resistance area starting at around 2075, which was the previous record high hit in August of 2020. The May high from last year was at 2081, so the area between those two levels is important. As you can see, price of gold has struggled to get through that level, at least on a daily closing basis. Remember, in December, gold did create a new all-time high. However, it didn't close above the previous all-time high. So the area between 2075 to 2080 is key to watch for gold in terms of short-term resistance. Speaking of gold and silver, silver is testing a key level of support as we speak. In fact, it's gone a little bit below the level I was anticipating a bounce from, which is this level right here. This small doji candle, which was engulfed by a big rally on the 13th of December. So the high of that previous day's candle at 23.15 is where I was expecting silver to bounce from. Well, it may still bounce from there because the day is not over. However, it's gone below it slightly at the time of recording. So keep an eye on that level as we move into the latter stages of today's session. Obviously, technical analysis is not an exact science. You do have to be a little bit flexible with your levels. And so if you select a range somewhere around here or slightly below, is you can see it was previous resistance, and then we broke through it cleanly on this particular day. So anywhere around here, if you see a bullish looking hourly candle form or another bullish like candle, then that could be a signal that silver may start to trend higher again. So that's a key level of support to watch, or potential support, I should say, because we don't know if the support is going to hold there. In terms of resistance, the first line of defense for the sellers is at 23.54, the low from the 29th of December. Thereafter, the 200-day moving average comes in with the point of origin of today's breakdown at 23.65. So if it were to get above this level at some stage in the future, regardless of what it does today, that would be a bullish outcome for silver. Let's look at the euro dollar very quickly. Last year's small bounce may be a signal that the euro has formed a bottom, at least for the time being. On a monthly basis, the euro was up for 3 consecutive months, or 2.5. The October's performance was a flat one. So on a medium-term basis, the trend is also somewhat bullish on the euro. And the weekly chart is showing a similar picture as well. However, you can see that the 200-week moving average has consistently provided resistance on the euro dollar, and it's proving to act as strong resistance once again, causing price to break lower. So at the time of recording, this level is now on the weekly time frame anyway, is key support at around 108.95. Let's call that 109. Okay, let's now move into the daily time frame and see if that level, well, you can see it bounced from there on the 15th of December quite aggressively. So from a bullish point of view, you don't want the euro dollar to go significantly below that level now if you're still bullish. Should the euro break 109 support decisively, then the 200-day moving average comes in at 108.45, which is also the base of the previous breakout. So that level is going to be the next potential support level to watch. In terms of resistance, the key area I'm watching now is around this area here. Let's call that 110. Previously, it had offered resistance before the breakout late in the month of December. So the retest of that level should have held as support. It didn't, broke down. So now if price comes back to test this level of potential resistance, we could see some reaction there. But if this level is reclaimed, and more precisely, if we get above the opening price for this year at 110.46, at that point, you'd have to drop any bearish bias you have on the euro dollar. Let's have a look at the FTSE 100, which is looking quite bullish for a change. So the crossover of the 21-day exponential above the 200-day, which are both pointing higher, is an objective way to say that the trend has turned positive following its recovery from the end of October. The FTSE has struggled, however, to break cleanly above its previous highs, starting at around 7,700, which has acted as strong resistance in the past and is proving to be a tough nut to break this time as well. But if we go back above this level on a daily closing basis, I think at that point, things will start to look a lot more bullish than they do at the moment for the FTSE. While we are talking about indices, let's have a look at a few other ones. I will discuss the DAX first. The DAX is still looking quite bullish. I know it's come back down a little bit in the last several days. It has been climbing sharply higher because of expectations that the ECB is going to cut interest rates in this year. So let's see if those expectations will be realized by actual rate cuts from the ECB as we head deeper into the year. But the fact that it has broken lots of resistance levels, including the shaded blue area where the DAX had previously formed major highs back in 2021, 2022, and then in July of last year, this area is now key. It needs to hold as support for the DAX to maintain its bullish trend. If it doesn't hold and we go below here, then that would be a short-term bearish outcome, in which case we could see a deeper correction towards perhaps this level at 16, let's call that 16,000, which is the base of the previous rally. So that could be the next downside target if the shaded blue area fails to provide support. In terms of resistance, the previous day's low is the level of resistance I'm watching at 16,650-ish. A move above that would be a bullish outcome, clearly. There are no other major reference points to watch except the December 2023 high. at 17,000. And then above that, you have these Fibonacci extension levels because the DAX is trading at all-time highs. Well, it will be trading at all-time highs should it get above the December high, which means that there will be no prior reference points to watch. So this is where Fibonacci extension levels, such as the one I've drawn from the July peak to the low back in October. I've deleted all the retracement levels, left out the extensions. So the 127 and 161.8 extension levels come in at the levels shown on the chart. For more analysis, make sure to check out the news and analysis section at cityindex.com. Take care.